All right, welcome. Today, we're diving in and going on a bit of a treasure hunt. We're digging deep into Waste Management, which is the biggest environmental services company in all of North America. Our goal here is simple: to figure out if this stock is a hidden gem for your treasure chest or if its current price is just, fool's gold.
And that really brings us to the core question, doesn't it? Pretty much everyone agrees waste management is a fantastic, incredibly durable business. But the big debate, and what we're here to really unpack, is whether a great business is automatically a great investment, especially at its current price. That's the mystery we're going to solve today.
So, first things first, let's get a handle on exactly why this company is seen as such a rock-solid business. To do that, we got to look at the nuts and bolts, or I guess in this case, the trucks and the landfills, of how it all works.
What the company runs is basically a complete, vertically integrated ecosystem for trash. It all starts with collection, right? Picking it up from our homes, from businesses, from industrial sites. Then all that waste gets transported and processed, recyclables get sorted out, and finally, whatever's left over ends up in landfills that Waste Management actually owns. And that last part, owning the final destination, that's the absolute linchpin of their whole operation. It's brilliant.
This powerful business model creates what investors love to call a moat, basically a huge competitive advantage, and it's built on three main pillars. First, as we just talked about, is landfill ownership. These are incredibly difficult assets to copy, mainly because of all the regulations. Second is what's called route density. The more customers you have in a single area, the more efficient and profitable every single truck becomes. And third, the regulatory barriers are just so high that it makes it extremely tough for any new competitor to even get into the game.
Okay, so we've established it's a great business, no question. But now for the million-dollar question, or maybe the $230 per share question. What is it actually worth? Let's dig into the numbers.
And here's where the problem really becomes crystal clear. Look at this. The company's calculated intrinsic value, so what it's probably worth based on its actual cash flows, is sitting around $162 a share. But the market is currently charging over $230. That is a 42% premium. That tells us the market price has gotten way ahead of the company's fundamental value. Now, to dig a little deeper on this valuation, we can use a really cool tool called the PEGR ratio. It's actually a pretty clever way to see if you're paying a fair price for a company's growth. It takes the normal price-to-earnings ratio and just adds some context by comparing it to both the earnings growth and the dividend that it pays out. So in short, it's asking, is this high price justified by how the company is actually performing? And wow, this number illustrates the problem perfectly. Waste Management's PEG ratio is 3.03. Now, a score around 1.0 would suggest a pretty fair price. A score this high, way above 1, that is a major signal that the stock is just plain expensive, even when you factor in its growth and its dividend. The numbers are telling a very clear story of overvaluation here.
So, what gives? Why the high price? Let's pop the hood and take a closer look at the company's financial health to see the good, the bad, and, the leveraged.
The company's financials are really a tale of two cities. On one side, you've got incredibly reliable, predictable revenue. Trash collection is essential, right? So that income is super steady. But on the other side, the balance sheet shows a pretty big concern: high financial leverage. Simply put, the company carries a lot of debt. Let's start with the good news, because there's plenty of it. Profitability is strong and it's stable. You can see it in their consistent margins, which are right around 11%. You see it in the steadily rising earnings over the past decade, and you definitely see it in their very reliable free cash flow, which averages over $2 billion a year. This is a high-quality earnings stream, no doubt about it.
But here's the other side of that coin. The balance sheet just isn't nearly as pretty. The debt-to-equity ratio is a hefty 2.45. The current ratio, which measures short-term financial health, is below 1, and that's a bit weak. Now, this isn't a crisis or anything, but it does show that the company is quite leveraged, and that makes it more sensitive to things like, say, rising interest rates.
Okay, so given this whole financial picture, we need to start thinking about the future. What are the key risks here, and what could this company be worth under a few different economic scenarios? So when we weigh the company's strengths against its weaknesses, a really clear picture starts to emerge. Strengths like being the industry leader and having that recurring revenue are obviously powerful, but they're almost completely canceled out by one major weakness: its premium valuation. So while the operations are solid as a rock, the stock's valuation is not.
And this is the real eye-opener. Even in a bull case, So, an optimistic scenario with 8% growth and a higher multiple, the intrinsic value only gets to $195 a share. The current market price of over $230 is trading above even the most optimistic best-case scenario we can come up with. For a value-focused investor, that is a major, major red flag.
So if today's price is just too high, what is the right price? How can you, as an investor, figure out a good entry point to maybe add this stock to your treasure chest down the road?
Well, the right price to pay really depends on your own personal investment goals. Let's take a look. If you're happy with, say, a 5% annual return, you could maybe justify paying up to $215. But if you're targeting a more ambitious 9% annual return, look at that. Your maximum buy price drops all the way down to $150.
And, time is a huge factor too. Let's stick with that 9% return target. If you only plan to hold the stock for 5 years, you could pay up to $205. But if you're a long-term investor looking out over a 16-year horizon, that price drops right back down to $150. The longer you want your money to work for you, the more disciplined you have to be about the price you pay to get in.
Okay, we've looked at the business, we've looked at the valuation, the financials, and potential entry points. It's time. Let's put it all together and deliver the final verdict.
I don't think I can say it any better than this. This single quote just perfectly captures this entire analysis. It's a company you can't help but admire, but it's attached to a stock price that is just very, very difficult to justify right now.
So the key takeaway from all of this is patience. Waste management is a superb, high-quality defensive business, but investing is all about the price you pay. At over $230, the stock just looks significantly overvalued. The analysis really strongly suggests waiting for a market downturn or some kind of price correction to even consider buying, ideally at an entry point somewhere below $160 per share.
And that wraps up our treasure hunt for today. So, while waste management is definitely one to keep on the map, it doesn't look like it's today's prize. The question is, what company should we dig into next? Let us know down in the comments which stock you want us to analyze for your treasure chest. We'll see you on the next hunt.